Listen to me carefully, because this is the difference between spending your twilight years with dignity or drowning in a quiet panic. You look at the grocery bill and feel that cold dread creeping in. You work harder than ever. Yet the goalpost is for retirement. It keeps printing away. Inflation is not just a headline. It is a relentless, invisible tax. A slow-motion confiscation of your energy. You see fiat currency melting like ice in a warm palm. And you think you need a miracle to survive. You think you need a six-figure salary just to avoid poverty. But I will tell you a mathematical truth so brutally simple that Wall Street spends billions trying to hide it. If you can scrape together just $100 a month, you can mechanically engineer a $500,000 portfolio. This is not a hopeful projection. This is the cold, hard gravity of compound interest. I know what you are thinking. You think it sounds too good to be true, because the financial media has brainwashed you into a state of learned helplessness. They have convinced you that wealth creation is a VIP room, accessible only to those possessing the mythical foresight to pick the next tech moonshot. You watch your neighbor brag about hitting the jackpot on some obscure crypto token, and you feel a sickening mix of envy. You think your ordinary income is a life sentence to mediocrity. That narrative is logically bankrupt and mathematically absurd. It is an illusion designed to extract management fees from your anxiety. In my decades of observing markets, I have seen countless geniuses blow up their accounts trying to outsmart the global economy. They treat the stock market like a casino, frantically trying to time the tide. They are playing a rigged game of roulette. The entire system is designed to make you feel stupid, so you hand over your money. But you do not need them, because you, armed with nothing but $100 and relentless consistency, are going to become the house. Part 1. When you get your paycheck, your primal instinct screams at you to do one of two incredibly dangerous things. You either hoard that money in a traditional savings account, locking your wealth in a burning building while inflation quietly robs you, or you get in its two-day trade. I see countless highly educated professionals fall into this trap. They think activity equals productivity. They sit reading charts, believing they are outsmarting algorithmic trading bots. This is a fatal systemic error. Your brain is hardwired for action, but in capital markets, action is the fastest way to bleed your net worth to zero. Let us look at the cold architecture of the financial system. The efficient market hypothesis proves all known information is already priced into the market. You cannot beat the collective intelligence of institutional computers processing terabytes of data per second. Instead, you must harness the brutal mathematics of compound interest. If you deploy $100 into a broad market in X every month, your money begins to clone itself. Early on, the growth looks microscopic, but as decades roll on, the interest generates its own interest. The parabolic curve steepens, transforming that meager monthly sacrifice into a $500,000 fortress of capital. This is a mathematical certainty dictated by time. The reason most people never reach that mark is not a lack of capital. It is a catastrophic failure of human psychology. Behavioral economics defines this as loss aversion. The pain of seeing your portfolio drop feels twice as intense as the joy of a game. When the market inevitably corrects, your amygdala triggers a primal panic, screaming at you to sell everything and flee to cash. This biological reflex forces retail investors to buy at the euphoric top and liquidate at the absolute bottom. The only way to survive your destructive biology is to remove the human element entirely. By automating your $100 ETF purchase, you build an iron wall between your money and your fragile trends. You are no longer a reactive prey animal fleeing market volatility. You become a cold machine that buys relentlessly, entirely blind to fear. Let me tell you about someone who refused to become that machine, resulting in a catastrophic failure disguised as brilliance. I knew a neurosurgeon who assumed his elite intellect would seamlessly translate to the stock market. He treated his brokerage account like an operating table, trading leveraged options and rotating sectors based on macroeconomic whispers. He was constantly in motion, buying speculative startups and shorting legacy retail, but he forgot about the drag of systemic friction. Every frantic trade bled capital through bid-ask spreads, short-term taxes, and exorbitant fees. Over a 5-year period where the baseline index surged, his hyperactive portfolio lost money. He paid a massive premium in stress just to wildly underperform the broader market. Contrast his agonizing defeat with the silent triumph of a maintenance worker in his very same hospital. This man never read an earnings report or studied an inverted yield curve. But decades ago, he set up an automated directive, siphoning exactly $100 from his monthly paycheck into a broad market ETF. He never checked his balance during the dot-com crash. He ignored the financial media screaming about the end of capitalism during the subprime mortgage crisis. He just let the automated system buy. By removing his ego from the equation, he allowed corporate productivity to compound for him. Decades later, while the surgeon nursed a heavily depleted account, that worker quietly retired with a portfolio effortlessly eclipsing $500,000. He won not by being smarter, but by being relentlessly and boringly disciplined. This brings us to the ultimate paradigm shift you must force upon yourself today. You have to abandon the toxic illusion that investing is an offensive war where you must outsmart Wall Street managers. The financial complex desperately wants you playing offense because your frantic trading volume pays for their corporate jets. True wealth accumulation for the everyday earner is a game of absolute, unbreakable defense. You do not try to find the needle in the haystack. You simply buy the entire haystack. By purchasing an index fund, you own a microscopic slice of the entire capitalist engine. You let the executives worry about quarterly earnings and supply chain logistics. Your only mandate is to protect your portfolio from your own worst impulses. You surrender the frantic need to predict the future and instead harness the undeniable reality that global human progress forces markets upward. This brings us to a truth so counterintuitive that most intelligent people refuse to accept it. In almost every human endeavor, effort is directly correlated with success. If you work harder, you get better results. But in the ruthless arena of building wealth, effort is inversely correlated to returns. The more you tinker and trade, the poorer you become. We have to drill this axiom into our minds right now. Boredom creates wealth, and action destroys it. The financial media hates this truth because boredom does not sell advertisements. But your goal is not to be entertained. Your goal is to secure absolute financial freedom. To achieve this, we must enforce strict operational protocols. I am not asking you to rely on willpower, because human willpower dissolves the moment a recession hits. I am telling you to build a system that bypasses your brain entirely. You must immediately set up a zero-friction, automated deduction of $100 from your checking accounts into your brokerage every single month. You never see the money, so you never miss it. More importantly, I am issuing an absolute prohibition against checking your portfolio balance when the market is bleeding. When you see a sea of red on Wall Street, you do not log in. You let the machine buy assets at a steep discount while everyone else panics. Now, what exactly is the machine buying? We are going to deploy a mercilessly simple allocation framework. Number 1. Allocates 70% to a total U.S. stock market ETF. This is your core engine, capturing the relentless profit motive of the greatest corporations on earth. Number 2. Allocate 20% to a broad international index ETF, protecting you from unforeseeable domestic stagnation. Number 3. Allocate the final 10% to a dividend growth ETF, creating a compounding snowball of cash flow. And finally, the one asset class you must avoid like a plague is the individual stock. You are not a hedge fund manager parsing satellite imagery of retail parking lots. Buying individual stocks is just gambling disguised as research. In the end, the transfer of wealth over the next decade will not go from the poor to the rich, but from the hyperactive to the patient. Will you be the one paying the toll?